Preface. Cash flow refers to the total amount of cash equivalents or real cash that moves in and out of business. Cash flow can be either positive or negative. Positive cash flow refers to increase in the liquid assets of a company, which will make it easy for the said company to take care of its financial obligations, like saving for the future, paying expenses, paying shareholders, reinvesting in the business, settling debts, and so on. Negative cash flow, on the other hand, means the liquid asset of the company is on the decline, which may make it impossible for the company to settle its various financial obligations. There is a difference between net cash flow and net income. The latter can include items for which the company has not received payment and account receivable. The quality of the income owned by a company can be assessed using cash flow phenomenon. It refers to how liquid the income is and can give an insight into the possibility of the company remaining solvent. Accrual accounting is one of the many aspects of cash flow analysis, and it enables a company to count their chickens before they hatch. This is because accrual accounting considers credit when calculating the income of the company. In this situation, the company can add settlement due from customers and accounts receivable as part of the items on its balance sheet. These may not count as cash, but they are added anyway as part of the cash flow of the company. Cash inflow of a company can also be from the sales of its long-term assets. The company will therefore increase its liquidity, but at the same time it will be limiting its growth potential in the long term. In such a situation, the company may be preparing itself for failure. A company can also borrow money and issue bonds to increase liquidity, but the outcome may also not be palatable in the long run. When considering the true state of a company, therefore, it is better to consider both the income statement and the cash flow statement of the company together. Introduction. What is cash flow analysis? Cash flow means the flow of liquid cash through a company over a given period. Cash is paid in return for material and labor in businesses that are run for profit. The revenue the company receives provides cash used for financing more sales and production. They can also be used in increasing the economic value of the company. Non-profit organizations like hospitals, schools and charities also benefit a lot from cash flow analysis, especially when these organizations need to meet their ongoing expenses that are associated with the services they provide. The manager of a company must understand how the company generates cash flow and the factors that are impacting the rate of cash flow. It will help the manager and the company to make very important financial decisions that can further increase the economic value of the company. The same issue applies to a non-profit organization. They need to understand their cash flow to increase their capabilities in service delivery to humanity. The management of a company has the responsibility of proper cash flow management, among other things. They must understand how to manage the working capital of the company, which is the operating liquidity the company have access to. A company can have profitability and assets, but it may be short of liquidity if it cannot convert its assets readily into cash. With working capital, the organization can continue its day-to-day operations and will also have adequate funds for servicing its maturing short-term debt and satisfying its operational expenses. Working capital management has to do with the management of the four aspects of the company's operations as highlighted below. First, cash. Second, accounts payable, money owed to suppliers. Third, accounts receivable, debts that clients and others are owing the company. Fourth, inventories, finished goods, work in progress and stock. Profitability of the company will be improved if it manages its working capital effectively. The managers will also not have to worry about insolvency and can therefore concentrate more on their works. Both non-profit and commercial organizations need to pay good attention to effective working capital management. It can reduce how much is required to run their activities and increase profitability. Importance of working capital management. Shortage of working capital can make a company fail. It does not matter if the company was once profitable, had full order book and many satisfied customers. When there is a shortage of working capital, an organization may find it difficult to pay its suppliers or workers. The company may be able to pay its workers and suppliers, but it may not have adequate working capital to venture into other investments or to reinvest into the business. As a result, the company may still end up folding up. The 4 areas mentioned above, vis-à-vis cash, accounts payable, accounts receivable and inventories, are very important to working capital management. A manager needs to have a very clear understanding of each of these factors for better understanding about how working capital can be controlled by the company. Debtors. Slow payment of invoices can cripple a company since it causes the company to have very little working capital. The company will have to spend time and money to chase up unpaid invoices. At times, the company may have to adopt an aggressive measure to get these debtors to pay up, which may negatively impact customer relationship. While it is imperative to retrieve debts from owing customers, you also need to handle the issue carefully to avoid damaging customer relationship. The company's policy on debt collection must set appropriate expectations and be polite while also being assertive. You can follow the tips below to make debt collection easier. First, agree with the customer in advance on payment terms. Second, send out your invoice promptly. Third, do not delay in resolving queries sent by the customer. Fourth, do not delay or wane in asking for payment. Fifth, focus first on the largest debts. Sixth, give credit control high priority. Seventh, make sure your credit policies are comprehensive. Eighth, keep in mind that you are only demanding for something that the customer had earlier agreed to pay. Stock or inventory. Make sure you keep stock as low as possible and work towards achieving a high rate of stock turnover. This will help you to reduce the impact on the working capital of your organization. This ideal is somewhat difficult to attain in real-life situation, though it is the right thing in theory. This is because the company has to meet all the commitments it had earlier given to its customers. The components of stock or inventory are: first, finished goods, which are the goods that are available. Second, work in progress, which include raw materials already committed to the production and partly finished goods. Third, raw materials, which include raw materials that are needed for goods production. Creditors. Many companies have adopted a policy to delay paying their suppliers for as long as possible intentionally. Many benefits are associated with this. For one, the company will be getting an interest-free loan from the supplier by delaying their payment. As a result, the company can access more working capital. Be that as it may, this strategy has its demerits as highlighted below. First, suppliers may not want to give the company any discount on goods purchased. Second, suppliers may end up delaying the request of the company for raw materials. Third, suppliers may find it difficult to trust the company again for fast raw material delivery despite all efforts to convince them. Fourth, if the company has any crisis, the supplier will not be willing to extend credit. Considering the above, it may not be a smart move to intentionally delay suppliers' payments, especially when it concerns very important suppliers. The company should try not to take more than a few days extra after supply to pay the supplier. Even if the company exceeds the time specified in the contract, it must not exceed the time for longer than few days. Instead of delaying payment for longer than it is necessary, the company should rather negotiate discounts, better delivery and better prices. Cash. An organization can be short of cash even though it is profitable. Factors that can cause this are highlighted below. First, when customers fail to meet payment terms earlier agreed. This situation usually occurs when promoters and sales agents are not saddled with the responsibility of enforcing payment. Second, when the company could not defer tax payments without attracting a penalty. This will unavoidably drain the company of cash. Third, When the company has to buy capital equipment that will gulp cash, this will reduce available cash. Fourth, when the company has to spend money on materials before selling goods. This can happen in an expanding company that needs to spend money on salaries, items for sale, and so on before it can complete sales and get its payment. Expenses and purchases usually precede profit and sales as a fact of business life. It is essential for a company to monitor and forecast cash payment and receipt accurately to avoid cash insolvent. A manager needs to make plans for known cost and contingency for any unanticipated challenge, like suppliers refusing to supply raw materials if the company does not pay up or late payment of debts by customers. This is called cash flow forecast, and the company should include it as part of its overall budgeting management process. As you are working on your cash flow forecast, areas where savings or improvements can be made will be highlighted for you. The cash flow analysis can equally help identify areas of potential problems. You can negotiate an additional overdraft with a bank or defer an investment for some weeks as part of your contingency plans. Lesson 1. What is cash flow? The term cash flow is more or less a generic term. As a result, its definition differs with the context in which it is used. The term can refer to projected future flows as well as actual past flows. Also, it can refer to the subset or sum of all the flows that are involved. Good examples are free cash flow, operating cash flow, and net cash flow. Cash flow forecast. Two different documents for accounting bear the term cash flow in their titles. A business manager must be careful not to confuse each of them. These documents are cash flow statement and cash flow forecast. A cash flow forecast is defined as an internal document that is produced on an ad hoc basis, and it is intended for budgeting. A cash flow statement, on the other hand, is regarded as one of the main financial reports published by an organization on a yearly basis, and it is published in line with international accounting standards. The cash flow forecast can display anticipated and known cash expenditures for a given period in the future, which can be the remaining period in the present budget or the next budgeting period, for example. Usually, the manager will be required to add a contingency element into the cash flow forecast, which can cater for an unexpected cost when such arise. The forecast should be seen as a very important aspect of budgeting and planning. Adopting it will help the company to identify ahead of time areas where issues may arise due to lack of cash. It equally gives the company an opportunity to review in details and amend expenditures planned for the future where necessary. It is very important for a company to carry out a regular reviewing and monitoring of its cash flow. This is so since no one knows when the company budget can be cut or threatened. Regular monitoring will ensure the company can protect its original budget, since all issues related to consequences and negative effects would have been settled. If the company is better prepared ahead of time, it will be easier for its budget to be protected. Budget planning and forecasting are a business for all senior managers of a company to tackle, since any slight change in the budget can have a notable impact on each of the departments. Cash flow statement. The accounting profession needs a cash flow statement for a given set of financial statements to be completed. There are certain acceptable accounting principles that the cash flow statement must adhere to, like it is the case with virtually all other forms of financial statements. You should look beyond the content of your regular reports when considering the cash flow statement. The report must show the cash coming in and going out. It can be said that a cash flow statement is more or less a reconciliation of the differences between cash flow, income statement, and accrual basis balance sheet. Cash flow statement makes use of historical data, and it can be dated at the end of financial year of an organization. Summarily, the statement shows the process via which the final cash balance occurred, from where money is coming from, and the amount that is coming in. It will also show how much is being spent and why the expenditure is taking place. The statement can show the liquidity of a company. It does not include transactions that have no direct effect on cash payment and receipt, but includes only cash outflow and inflow. The cash flow statement is a cash basis report, and it gives reports about 3 types of financial activities, which are financing activities, investing activities, and operating activities. The cash flow statement is highly valuable to companies' investors and management for the reasons given below. First, it gives information on the solvency and liquidity of an organization. It also depicts the ability of the organization to modify its cash flows if situations warrant such in the future. Second, it gives the additional information required for evaluating changes in equity, liabilities, and assets. Third, it brings about an improvement in the various operating performance of the organization by removing the unwanted impact of various methods of accounting. Fourth, it equally indicates the timing, amount, and probability of cash flow for the future. The company will find cash flow statement helpful in making important decisions due to the valuable data and information it provides. As a result, it is very important for members of a company's management to understand how to compile and interpret the statement fully. Many companies have adopted the cash flow statement as their standard financial report, since it removes some of the pitfalls encountered when comparing already accounts prepared with different methods of accounting, like different time frame for fixed assets that are depreciating. Cash flow statement is more or less integration and compilation of facts. This ensures it draws investors and managers to rely on it for proper financial planning, though the statement is still being overlooked in some quarters. All the financial figures that are present in the cash flow statement can still be found in any of the provided financial statement notes, like the income statement, statement of shareholders' equity, and balance sheet. The information provided by the cash flow statement can be applied in many different ways. For example, if the cash generated by a company from its operations is consistently higher than its net earnings or income, they are labelled as high quality. The earning is, however, tagged with a red flag if the reverse is the case. A red flag should tell anyone looking into the company's statement that there is need to carry out further investigation why no cash is being generated from the company's reported earnings. A company can afford to give its investors a higher dividend if it is earning more cash than it requires for its daily activities. The company can also use the excess cash being generated to buy back some of its shares. Such a company is tagged by investors as having good stockholder value. Aside from the points mentioned above, the company can, as well, use its excess cash to buy another company or reduce its debt. If it is a non-profit organization, it can use its excess cash to expand its operations and also provide improved or additional services. Lesson 2. Understanding changes in cash. The cash account is being explained in a counterintuitive manner in recent times. More light will be shed on the concept in this lesson. For a change in assets to occur, an opposite change in cash account must occur. In the same vein, for a change to occur in owner's equity and liabilities, the change in the company's cash account must occur in the same direction. Cash account usually increases when there is an increase in the equity of the owner. Cash account usually decreases when there is an increase in assets other than cash. Also, there is an increase in cash account when there is an increase in liability. On the other hand, the cash account will decrease when there is a decrease in the equity of the business owner. The cash account will also increase when there is a decrease in an asset other than cash. Finally, there is a decrease in cash account when there is a decrease in liability. Direct format cash flow statement. A company can easily create a report listing all the cash transactions individually. However, this does not add anything extra to what is already available on the bank statement, since it does not show outflows and inflows in any meaningful way. Showing a net sum of cash movement and grouping cash payments together for a given period is more useful. When the resulting net cash flow is applied to the cash balance at the start of any period, it becomes possible to arrive at the month-end's cash balance. The summary of a cash account is provided by showing cash outflow and inflow following this manner. However, it gives no provision for net income. Neither does it explain if there is the difference between net cash flow and net income. Analyzing these figures in a meaningful way is somewhat difficult. As a result, a published account will almost always use the direct method of presentation. This format of presentation is the chosen format for virtually all financial reports being published by public companies. This is also the same format adopted by many of the accounting software around. Indirect format cash flow statement. It is a unique statement beginning with the net income and adjusting for any change in the account balance that may affect any cash available. It may be somewhat difficult to understand it at the beginning fully, but it has great potential for cash flow analysis. The indirect format cash flow statement can also be used to proffer answer very important questions, like the difference between the net cash flow and net profit. When this method is used in preparing the statement, it will have 4 sections, which are: first, supplemental information; second, financing; third, investing; fourth, operations. Supplemental information. It reports exchange involving significant items not involving cash and equally reports the amount of interest paid and income taxes paid. Financing. It reports about the payment of dividends and repurchase and issuance of the stocks and bonds owned by the company. Investing. This reports the sales and purchase of property and long-term investments, equipment and plant. Operations. The first entry in the indirect format cash flow statement is the income. It was derived from the income statement for a given period. A presumption is made that net cash flow is equal to net income aside from the adjustments making up the details of the statement. The operation can be defined as the entire process involved in directing the activities of the company related to cash flow, like paying employees, manufacturing, buying and selling goods and services. The entries provided under this title can convert the reported items on the income statement effectively to cash from the accrual basis of accounting. The manager needs to read through the line descriptions one after the other to fully understand the various information provided by the indirect format statement. Net income is the first item under operation. The major purpose of the statement is to tell the difference between the net cash flow and the net income. The figure of the net income figure is expected to be similar to what obtains on the income statement for that particular period. Adjustment. Some of the outstanding points to note in adjustment include: first, account payable; second, inventory; third, prepaid expense; fourth, accounts receivable; fifth, depreciation. Each of these operating items has a great impact on the cash not added to the income statement. Depreciation. The monthly payment on depreciation expenses needs to be subtracted from the net income reported. This means it needs to be added again to increase the net income further. Depreciation can be defined as the gradual charging of the cost to expense all through the useful lifetime of any item. It is usually recorded on a monthly basis after putting the asset into use without any cash changing hands consequent of the depreciation entries. Account receivable. Debts collected over the reporting period will increase the total figure of cash but will decrease figure of the accounts receivable. Allowance must also be made for any credit sale remaining unpaid during this reporting period. Outstanding cash collection can be found by subtracting ending accounts from starts account receivable and adding sales to the leftover. Prepaid expenses. It refers to upfront expenditure or costs for insurance and other things. The net effect of cash flow adjustment can be calculated by considering the net change in account balance of the prepaid expenses recorded on the balance sheet from the start to the end of the given period. It means there will be an increase in the recorded cash balance if there is a decrease in the net figure of the prepaid expenses over the given period. Inventory. Inventory on hand is required by most companies. Also, modification of inventory balances has the same effect on the cash account like accounts receivable. Do not forget that income statement represents the total cost of every inventory that has been sold in the reporting month. The cash cost of any inventory added in this period needs to be deducted from the cash flow statement. It can be done perfectly by subtracting ending inventory from beginning inventory. On the other hand, the inventory cash cost that had been deducted in this period must be added to the cash flow statement. Account payable. The amounts owed to a creditor represent the figure for the accounts payable. The cash cost of all increments in accounts payable recorded during the reporting period must be added to the cash flow statement. This gives a wholesome representation of all the monies the creditors had borrowed the company. Cash for investing. It reports on the sales and purchase of property, equipment, plant and long-term investments. They include short-term investments sold and capital expenditures. Short-term investments sold. A company can decide to put its excess cash into an investment. This way, the money can accrue interest until the time it is needed for its original purpose. In most cases, only short-term investments are considered by the company, and securities or bank certificates are the common vehicles used for such an investment. The company can then sell these vehicles when cash is needed. The investment will be recorded as a cash expenditure when it is purchased. It will also be recognized as a reduction in cash. After selling the investment, its net proceeds is recorded as addition all source of cash, except if there is loss or gain in the sales. The gain or loss can be recorded in the income statement. Many companies that had been involved in many successful initial public offerings, IPO, can raise adequate amounts of cash long before such cash is required for business operation. With short-term investment, the company can easily earn an income from many of these idle cash balances. Capital expenditures. They represent all the money spent on the company's fixed assets recorded on the company's balance sheet but not charged to expenses when they were bought. This means these assets were capitalized and they later depreciated during the period in which they are used. When creating cash flow statement, it is imperative to separate amount borrowed for purchasing equipment from amount spent on equipment from the company's purse. Even if the company had already recovered the amount spent on purchasing the item when it borrowed the money, the decision of the company to buy that equipment should be seen as a cash commitment and should appear on the cash flow statement as a deduction. If the purchase is financed by the company, it should be recorded as an offsetting item in the cash flow statement under the financing section. Cash from financing. Cash inflow from financing activities includes cash from shareholders and investors like banks. Cash outflow, on the other hand, including money paid to shareholders in the form of dividends as the company is generating income. Several factors or financing activities can impact long-term equity and liabilities. They include, first, bank debt, which is the total amount of monies the company has borrowed from a bank. Second, dividends, which represent monies paid to investors as the organization becomes profitable. Many of these payments are made in cash. This form of cash is recorded in the cash flow statement. Net cash flow. It represents the summation of all preceding entries, and it should amount to the change in cash balance during a reporting period. The final step involves adding the beginning balance appearing on the balance sheet of the previous reporting period, which will represent the new ending cash balance. As a result, the cash flow statement is tied into the first line of the cash flow statement, that is the income statement. Supplemental information. It involves interest paid, income taxes paid and items exchanged not involving cash. Also, it does not show on the report but can be appended to it. Some of the examples of non-cash supplemental information include: first, share issuance in exchange for assets. Second, non-cash liabilities or assets exchange for another non-cash liabilities or assets. Third, Debt conversion top equity. Fourth, purchasing an asset by leasing. Lesson 3. Processes in cash flow analysis. Cash flow indicates the cash position of a company, while the income statement of the company indicates its net income or profit. These statements further cement the place of importance of statement of cash flows and income statement as the two most important financial statements in cash flow analysis. A business owner needs to understand these two statements, considering the importance of cash when operating any business. The business can be lost if the company is poor in cash while being profitable. Cash flow of a company refers to the amount of liquid cash available to the company at the start and end of an account reporting period. With adequate cash, a company can easily purchase assets, service its debt, respond to direct expenses, and pay for its operating expenses. Cash can come in the form of sales of assets, investments, and loan proceeds. Process involved in cash flow analysis. Cash remains the major oil that greases the wheels of business. With detailed cash analysis, a company can easily assess its financial health. It is more or less a study based on cash movement through the business for determining the pattern of how cash comes in and how it is spent. Cash flow analysis aims to reserve adequate liquid cash for the smooth operations of a company from one month to another. It is referred to as cash budget. First of all, the company needs to determine the amount of cash coming in during a given period, say a month. The beginning balance should also be added if the business is just starting. The amount or number of sales generated for that month also needs to be included. When considering sales, it should include sales made to customers on credit and those for which cash is paid. Next, the amount of cash that will be spent during the reporting period should be considered. These outflows can include money for stationeries, advertising, payroll expenses, and vehicle expenses, and so on. Taxes and other quarterly expenses should also be considered. Some expenses occur once in a while, like expense for buying vehicles, computer equipment, and several other large expenses. The main focus of cash flow analysis is to ensure that the amount coming into the company is more than the amount being spent. This way, the company will have adequate cash to finance its expenses during any reporting period. The ending balance for a previous reporting period will represent the starting or beginning balance for the next reporting period. As the business expands, it may become necessary to add new items to the cash flow analysis. The company may have to borrow money to continue running its activities if it ever experiences negative cash flow in any reporting period. Such money can be borrowed from banks, investors, friends or family. The company needs to keep borrowing to the barest minimum and also make an effort to increase cash inflow. Items required for detailed cash flow analysis are: first, computerized accounting programs. Second, sales, expense and receipts. Third, an idea of the cash amount needed for that particular reporting period. Fourth, the initial beginning cash balance from previous reporting period. Data required for statement of cash flow preparation. The account manager needs to consider the comparative balance sheet of the company when preparing the statement of cash flows. It is also very important to consider income statement and balance sheet data to make the process run smoothly. The cash flow statement has 3 sections. Cash flow from operating activities represents the first section, and net income is in line 1, while depreciation can be found on the second line. After taking the depreciation and net income into consideration, it is also important to consider any increase or decrease in current liability accounts and the current asset. Another factor to consider is the net cash flows from operating activities, which is the first section in the statement of cash flows. The cash flows from investing activities involve long-term investments made by the company, including its investment in fixed assets like equipment and plant. Cash flow from financing activities also deserves consideration, and it can be found in the last section of the cash flow statement. It involves long-term bank loans and other related financing activities. All these sections need to be closely considered to have a clear understanding of the company's stand from the perspective of cash flow. One of the most important results generated from cash flow analysis is the free cash flow calculation. It is one of the outstanding outcomes of the statement of cash flow analysis. One can say that free cash is the leftover cash after paying for capital expenditures, like equipment or plant. It can also be referred to as the cash leftover after paying off investors and meeting all other financial obligations. The company almost always keeps dividend payment till it has offset all other financial obligations, since the obligations are more or fewer expenditures. Cash flow is not easy to manipulate, unlike net income or earnings per share. Cash flow analysis is essential and has several advantages to a company, some of which will be discussed next. Its benefits. Cash flow analysis can help a company to maintain adequate cash reserves. With the help of cash flow analysis, the company can easily predict when its customers will make payment. As a result, making plans for bill payment will not be difficult. It also helps in managing credit better. The company can easily prepare ahead of time by keeping adequate cash or preparing for a loan on time to meet its financial obligations. Its analysis can be based on income and expenses. It also helps in building a cushion for late payments, bad debts and cost overruns. Mismanaging credit can hamper the company, making it unable to pay its bills. Cash flow analysis can help a company to make all necessary adjustments to keep the company operational in the face of financial difficulties. The company can use the report generated to reduce its spending in certain areas until receivables increase. The right application of cash flow analysis enables the company to avoid production interruptions, which can reduce customers' confidence and cripple the business. A company depends on available credit and not credit on paper for making payroll, ordering supplies, and putting down deposits for assets. Profit can be negatively impacted by even a temporary halt in production. The halt in production can give rise to uncomfortable rumors, which can have a negative impact on the company's brand. The halt in production can render the company unable to fill orders, and the customers may start searching for new suppliers, which will never augur well for the company. Conclusion. In the course of this text, an in-depth explanation of the cash flow statement has been carried out due to its place of importance in cash flow analysis. The cash flow statement has also been shown to be a reliable analysis tool that makes it easy to compare accounts prepared using various accounting methods, like different timeframes for depreciating fixed assets. Other financial statements also show the information available in the cash flow statement, and there are several ways to use the information available in the cash flow statement for cash flow analysis. This text has delved into some of these various ways. It has been shown that the cash flow statement can be used for identifying cash flowing in and out of an organization, aside from being used in comparing the company's cash from net income to operating activities. The direct and indirect methods of presenting the cash flow statement have also been described here. It has equally been shown that the main merit of the indirect method borders on its ability to differentiate between the net cash flow and net income of the company from the operating activities. As a result, the indirect method provides a very useful link between the income statement, balance sheet, and statement of cash flows.